Emergency alert. Is $76,000 really the bottom for Bitcoin? The market's still full of short sellers right now, but Bitcoin just isn't dropping. Help DAO got wrecked by fake news with $292 million down the drain. Just one nod and $292 million was gone. Aave's facing a bank run, and the DeFi trust chain is shattered. Everyone's asking the same thing. Can I still get my money out? Tonight, BTV is diving deep. Is this a signal that we've hit the bottom, or is it just a trap? It's Thursday, April 23rd. Welcome to BitcoinTV's Chinese channel. I'm Dong Dong. Our show is broadcast daily in Vietnam, Japan, Thailand, Spain, and English-speaking regions, with local hosts in their native languages. First, let's look at the top crypto data from the last 24 hours. Bitcoin is hovering around $76,000. The price hasn't flinched, but the funding rate on Binance over the last 30 days is still at negative 4.5%. It seems the bears are still holding on tight. Remember back in 2022, near the end of the bear market, this indicator hit negative 7%. But then, Bitcoin actually bottomed out and started to climb. Even now, there are plenty of people shorting the market, yet Bitcoin refuses to drop. It's not as extreme as before, but the bears clearly aren't backing down yet. The more desperate the bears get, the more fuel they provide for a potential rally. Ethereum is currently around $2,368, up nearly 2% in 24 hours. Trading volume is at 337,000 units, and with the RSI around 60, it might have more room to run in the short term. ETH inflows to Binance have surged to 372,500 units, which is well above the 7-day average. This suggests that people are starting to move their ETH to exchanges, likely getting ready to sell. The global SOPR is at 1.0157, meaning most people are in the green. Retail investors are selling as prices rise, but institutions and long-term holders are still buying. Specifically, the ETH whales holding between $10,000 and $100,000 are still at a loss, so they're in no rush to sell. Simply put, retail is selling while institutions are scooping it up. We're looking at support at $2,090 and resistance at $2,430. Now we'll see if the market can hold up against this wave of retail selling pressure. This time, Justin Sun isn't just arguing, he's completely flipped the table. He's taking World Liberty Financial, a crypto project linked to the Trump family, to US court on charges of extortion. He claims he invested $45 million for about 3 billion WLFI tokens, plus another billion for his advisory role. When he refused to put in more money, they froze his tokens, costing him hundreds of millions of dollars. What's even more intense is that this lawsuit isn't just about settling old scores, he's also exposing the project's lack of stablecoin reserves. This isn't just a falling out between crypto partners, it's a head-on collision between capital, politics, and the crypto world. If this legal battle continues, it's going to burn a lot more than just one project. Recently, something absolutely ridiculous happened in DeFi. A cross-chain bridge was tricked by a piece of fake news. The system made a wrong call and released 116,500 ETH, worth about $292 million. What's worse is that these tainted assets didn't just vanish. They were used as collateral on lending platforms like Aave to borrow real ETH. In other words, the bridge was tricked first, and then the risk spread into the lending market. Today, we're going to break it down and see exactly how this money was lost and why tainted assets could still borrow real cash. How did this whole situation drag the entire DeFi ecosystem down with it?
Think of a cross-chain bridge as a currency exchange window between different blockchains. One side locks the assets, and the other releases the tokens. What KelpDAO does is allow RSF to move between different chains. Whether this window is secure doesn't depend on the bridge itself, but on the verification system. Every cross-chain transfer must first confirm that the operation actually happened on the source chain before the target chain releases the assets. Who confirms it? How is it confirmed? This is the most critical part of the entire situation.
And that's exactly where the problem lies. Normally, for such a large sum to cross chains, multiple validators would need to sign off before the system releases the coins. But KelpDAO was using a one-of-one DVN configuration. That means only one validator was needed. If they said yes, the system released the funds, so one person nodded and $292 million vanished. Doing it this way is faster and cheaper, but if that single validator is tricked, everything else is lost. So the real killer here wasn't how brilliant the hacker was, but that the system itself believed a fake message and mistakenly released the RSF.
On the 18th of April 2026, at approximately 17:35 UTC, an attacker called a single function on a layer 0 contract and walked away with 116,500 Roseth, worth approximately $293 million, from Kelp DAO, making this the largest DeFi exploit of the year so far. Within minutes, that stolen collateral had already been weaponized across Aave, Compound, and Euler to borrow another $250 million in clean ETH. And within hours, panicked users had stripped over $6 billion of liquidity from Aave alone, withdrawals had been frozen across the entire ecosystem, and more than $10 billion from DeFi's overall TVL had been erased.
This attack actually had 3 steps. First, the hacker prepared the routes for receiving and transferring the money. Second, they didn't attack Aave or the Ethereum mainnet directly. Instead, they bypassed the bridge's verification, tricking the system with a fake message it thought was real. Third, the bridge believed it and released the assets directly to the hacker. So, the real issue this time wasn't Aave or Ethereum, but the verification process of the cross-chain bridge.
But it didn't end there. After stealing the RSETH, the hacker didn't just run off. Instead, they deposited those tainted assets into Aave as collateral to keep borrowing real money. The risk didn't stop at the bridge. It spread right into the lending market. And that's where the real trouble with this incident lies. After the Kelp DAO bridge exploit, the market's eyes turned to Aave. That's because once the hacker got the RSETH, they didn't just vanish. They used it as collateral on Aave to borrow funds. The market's biggest fear isn't just the loss of $292 million, but whether these tainted assets will drag Aave down with them. What everyone is really worried about boils down to one question: can I still get my money out of Aave?
Aave is one of the largest lending platforms in DEFI, managing about $26.4 billion in assets before the incident. Many people deposit funds there to earn interest, while others provide collateral to borrow ETH and stablecoins. So it's like a massive liquidity pool for DEFI. If Aave gets squeezed, the entire market feels the tension. As far as we know, this could be the largest hack in the history of our industry.
In fact, it's probably the biggest single theft in any industry ever. $1.5 billion gone in seconds. And even in the early hours after the hack, fingers began immediately pointing in one direction: North Korea.
The scariest part of a bank run isn't how much is on the books, but whether there's actual cash in the pool when you try to withdraw it. And that's exactly the nerve Aave hit this time. As users withdrew funds, the hacker was simultaneously borrowing ETH and stablecoins, quickly draining the available balance in some pools. Simply put, it's not that the money is gone from the books, but that the immediately accessible cash has dwindled. For DEFI, this is even more terrifying than a simple price drop. Because if the price drops, you can still sell, but if liquidity vanishes, you can't even escape.
And the panic didn't just stop with Aave. Because DEFI isn't a collection of silos, it's a deeply interconnected web. Kelp's RSETH is linked to several protocols. When one fails, the downstream lending, liquidity, and risk management all tighten up. So the real headache here isn't just the bridge exploit, but the risk cascading through the connections between these protocols. In normal times, we call this efficiency. But when things go south, it's a chain reaction bank run. After the Kelp DAO incident, it wasn't the retail investors who panicked first, but the whales. Because if this situation continues to escalate, it won't just be Kelp DAO that's affected. It'll also involve Aave, RSETH holders, and the entire DeFi market. But the problem is this isn't the first bridge to have an issue, and it won't be the last. Over the past few years, cross-chain bridges have been hit repeatedly. The industry says it will change every time, but the next bridge still ends up having problems.
In recent years, cross-chain bridges have had issues almost every single year. In 2021, Poly Network lost about $612 million. In 2022, Ronin Bridge lost about $625 million. Wormhole lost about $320 million, and Nomad Bridge lost about $190 million. Later, there were also Multichain and Harmony Horizon. By April 2024, Kelp DAO lost about $292 million again due to cross-chain configuration issues. The total losses from cross-chain bridges and related infrastructure over the years have already exceeded $4 billion. The problem is very similar. It's not that the main chain is broken, but that there's an issue with the bridge, which is the middle link.
They are extremely sophisticated in what they're doing here. Out of all the illicit actors involved in cryptocurrency, North Korea really are the best at laundering crypto. I imagine they have a whole room of people doing this. They're using automated tools. They're extremely sophisticated.
For 5 years now, cross-chain bridges have been the most problematic area in DeFi. The reason is quite simple. Different blockchains naturally don't trust each other, so the bridge can only act as a middleman, responsible for guarantees and authorization. The more money there is, the more a bridge becomes like a vault door, and the more attackers want to break it down first. The core issue for Kelp DAO this time is that while managing nearly $300 million in cross-chain assets, the key configuration was only a one-of-one DVN. Simply put, if one person approves, the system trusts it.
Afterward, Layer 0 pointed preliminary clues toward North Korea's Lazarus Group, specifically the trader-traitor branch. This direction is worth paying attention to, as North Korean hackers have been involved in many large-scale crypto theft incidents over the past few years. However, to be clear, this judgment is currently just a preliminary statement from Layer 0 and cannot yet be considered fully confirmed. A more cautious way to put it is that if this direction holds true, then this isn't just an ordinary hacker attack, but a state-level attacker targeting DeFi infrastructure once again.
Kelp DAO, despite securing close to $250 million worth of bridged collateral, had configured its bridge with a one-of-one DVN setup. So put simply, the protocol delegated the entire security of the bridge to one signing key controlled by one entity. Slow Mist, the security firm that performed the post-mortem, described this configuration as the weakest security level the Layer 0 framework permits. And the red flag had been there in plain sight for over a year.
After the incident, DeFi is dead went viral once again. But the real question isn't whether DeFi is dead or not, but whether it has actually grown up yet. 5 years now, and cross-chain bridge lessons are almost all the same. Not enough validators, opaque off-chain reliance, and risk control that's just too slow. The industry talks about decentralization, but in reality, it's always taking shortcuts. This $292 million from Kelp DAO is frankly just a bill for wishful thinking. DeFi isn't dead, but it can't keep pretending to be mature anymore. The real irony of the Kelp DAO situation is that in the end, what actually saved some of the money wasn't the code, it was people. On April 21st, the Arbitrum Security Council took emergency action, freezing a portion of the attacker's ETH on Arbitrum 1. So here's the question. After a DeFi incident, the one thing everyone fears most is, can I still get my money out? Should users ultimately trust the code or trust the people?
At the time, the attacker was preparing to withdraw this ETH back to the Ethereum mainnet. The Arbitrum Security Council stepped in immediately, transferring 30,765.6675 ETH into a protocol-controlled address. That's basically locking down about $70 million. But while the money was saved, the controversy followed right behind it. If this system can move money from a specific address in an emergency, then can it really be considered fully decentralized?
And that's exactly where the biggest contradiction of this incident lies. If no one can intervene and the hacker gets away, users will blast you for having no protection. But if someone takes emergency action and the money is saved, the market asks, is this even decentralized anymore? This Kelp DAO situation also proves a point. DeFi isn't about a lack of trust, it's about shifting that trust from banks to code, validators, and governance mechanisms. The issue isn't whether power exists, but whether that power is transparent and properly constrained. This $292 million leaves the industry with more than just a lesson about being hacked. It's a reminder. Truly mature DeFi isn't about never having problems. It's about knowing where the risks are before they happen, knowing who can step in when they do, and knowing who's responsible afterwards. What we've been doing isn't just reporting the news, it's deconstructing structures to see the underlying essence. If you find this logic helpful, remember to follow and turn on notifications. And if you want to go deeper, our advanced channel is ready for you. From Monday to Friday, I'll take you through a market review to find certain opportunities within the trends. I'll see you all tomorrow.